This LOS is compare the financial reporting of investment property with that of property, plant, and equipment. Investment property. Okay, the first thing to point out is that investment property is a classification under IFRS, okay? Under US GAAP, there is not a special classification for investment property. So I've shown this slide before with regards to some of the international accounting standards under IFRS for long-term assets, okay? And so this is just a quick review. International Accounting Standard 16 covers plant, property, and equipment. International Accounting Standard 17 covers leases. International Accounting Standard 28, investment associates. That's not a focus of this chapter. International Accounting Standard 38 covers intangible assets. And now we're looking at investment property with regards to this learning outcome statement. And that's covered by International Accounting Standard 40 under IFRS. Investment property. So first we'll start with the definition. Investment property is defined under IFRS as property that is owned, and this is important, or in some cases leased under a finance lease for the purpose of earning rentals or capital appreciation or both. Okay, so that's the definition. Investment properties do not include long-lived tangible assets held for sale in the ordinary course of business. For example, the houses and property owned by a housing construction company are considered to be its inventory. So that's an important distinction. Under IFRS, companies are allowed to value investment properties using either a cost model or a fair value model. The cost model is identical to the cost model used for property, plant, and equipment. The fair value model, however, differs from the revaluation model used for property, plant, and equipment. Under the revaluation model, whether an asset revaluation affects net income depends on whether the revaluation initially increases or decreases the carrying amount of the asset. In contrast, under the fair value model, all changes in fair value of the asset affect net income. Okay? To use the fair value model, a company must be able to reliably determine the property's fair value on a continuing basis. Okay? Under US GAAP, there is no specific definition of investment property. Most operating companies and real estate companies in the United States that hold investment type property use the historical cost method. Investment property, we're just going to cover some key terms now. Investment property, land or building or part of a building or both held by the owner or the leasee under a finance lease to earn rentals and or for capital appreciation rather than to use in production or supply of goods and services or for administrative purposes or for sale in the ordinary course of business. So that's the definition of investment property. Owner-occupied property is property held by the owner or the lessee under a finance lease for use in production or supply of goods and services or for administrative purposes. One of the distinguishing characteristics of investment property compared to owner-occupied property is that it generates cash flows that are largely independent from other assets held by an entity. Owner-occupied property is accounted for under IAS 16, property, plant, and equipment. Investment property shall be recognized as an asset when and only when, 1, it is probable that future economic benefits will flow to the entity, and 2, the cost of the investment property can be measured reliably. An investment property shall be measured initially at cost, including transaction charges. Again, the principles for determining cost are similar to those contained in International Accounting Standard 16, in particular for replacement and subsequent expenditure. Investment property, measurement after recognition. An entity shall select either the cost model or the fair value model for all of its investment property. There are, however, 2 exceptions. 1, if an entity elects to classify property held under an operating lease as investment property, then it must select the fair value model for all of its investment property. 2, the second exception is if the entity has investment property backing liabilities that pay a return linked to the fair value of the assets. If so, regardless of which model is selected for measuring such investment property, the entity continues to have a choice of models for its other investment properties. If the fair value model is selected after initial recognition, investment property shall be measured at fair value. Fair value is the amount for which an asset could be exchanged between knowledgeable, willing parties in an arm's length transaction. Any gains or losses from changes in the fair value shall be recognized in the income statement. This is quite a radical divergence from previous practices, but is consistent with other standards wherein assets are held in part for capital appreciation. So it's like, I guess a similar would be securities held for trading. Unrecognized gains and losses are all put through the income statement. Okay, so you can see here with regards to investment property, any gains or losses from the changes in fair value are going through the income statement. That's going up and going down. Remember, with the revaluation model, if we revalue down, it's going through the income statement. But if we revalue up, it's going through equity directly through a revaluation surplus. So that's a key point that you have to understand, okay? That with regards to investment property, ups and down is going through the income statement. If on acquisition it's not possible to determine fair value reliably on a continuing basis, then the asset shall be measured using the cost model under International Accounting Standard 16 until disposal. Residual value shall be assumed to be zero. Therefore, it is possible for an entity to hold investment property, some of which is measured at fair value and some under the cost model. And that's the last slide for this LOS. Thank you.